very good afternoon, ladies and gentlemen. Welcome back to the AI Conclave 2025. Well, sharp, we're ready to begin with the second half of the day one. Remember, there's going to be day two tomorrow, wherein we're going to also be having the awards. So a lot is in store for you for today as well as tomorrow, wherein we're going to have sessions as well as awards. Now on the other side, as per the agenda at 2 o'clock scheduled, is how AI can help in investment management landscape. And it's indeed important to have somebody from that domain talk on this topic. So ladies and gentlemen, we have an expert in the investment and wealth management with over 23 plus years of experience across banking, asset management, fintech, and the structural products. He currently leads Ashika Investment Managers AIF arm, shaping the product development as well as the strategy. Previously, he's worked for brands and has held roles at the London Stock Exchange Group, FinIQ, and the India Bulls Group. Somebody who got about pioneering the digital solutions for banks. So a very relevant experience, talking on a very relevant topic of today. He's somebody who has spearheaded major analytics and sales initiatives and advised prominent global financial institutions. And he's renowned for his entrepreneurial vision, while as he also drives innovation at the intersection of finance and technology. So at the AI Conclave 2025, ladies and gentlemen, let's give it up for none other than Alok Sasmal.
Good afternoon, friends. Okay, let me do a practice. Let's clap for yourself. Okay, great. Thank you. Just checking whether we'll be talking about neurons. So I was checking whether biological neurons is working or it's working very well. Thank you so much. So before jumping into this, we'll have tight next 30 minutes to discuss about the perspective of how AI is touching the investment management space. Before jumping into just quick background, I've spent initial 18 years into wealth management and investment management space, and then COVID happens. So COVID has actually touched life across different industries, human being, people, and the way we look at the world. And that's the year I also pivoted from a investment management to technology, co-founded one of the investment analytics company, and that's how my journey to data analytics and technology started. Developed a couple of platform for global structured product platform for top 50 banks globally, along with some of the banks in India. Then moved to London Stock Exchange Group. That's where how AI analytics could give a better perspective that started. Again, after 5 years into data technology, I have came back to the same industry where I was in 2020. The perspective has changed. Now it is more of a how solutions or data-driven solutions can generate better product. Till 2020, it was more of as an industry, it was more of a product-driven, and gradually we have moved from product to solutions, and from solutions to hyper-personalized insight. That's the journey we are moving toward, and AI is touching all across. Today, I'll speak about how and what are the components being adopted in investment management. Some of the AI use case are not or maybe not relevant at this moment, but we'll stick to what are relevant today. Assuming the audience are diverse, so I'll stick to the simplified version of this interpretation. So this is the first disclaimer, since I represent one of the asset management company. So all the narratives or the points I'll be discussing, we may or may not use in our regular practice. Today's session is just a generic understanding, and it does not suggest any advisory or any suggestion to invest in our fund. Thank you. So there are two parts to it. So AI could be used in operational efficiency or could be investment decision making or optimizing the investment. So today we are living in a world, everyone in their respective field wanted to predict the future, so as in investment. So AI could be used in two perspectives. One is how we can accelerate the work as human being we do on a day in day out basis. I may not touch that part because that is common across. I believe you had a wonderful session since morning, and it is more or less common across all industry, all businesses. But which is slightly different, that is how investment decisions or predictive analytics been used to create a portfolio or recommendation of stock. That's where probably I'll spend my time. So in nutshell, I believe today mutual fund is not a passe. Everybody understand mutual fund or know about mutual fund. So any managed fund work in this architecture. One side, it is the investment management team comprising CIO, fund manager, research analyst. What they do basically, they take the data, all the structured data, largely it's been structured data which has been used since last 20-25 years, the time I've spent in the market. So all the structured data been used by the team of a researcher to generate insight. That insight is to give a direction where that particular company, it's investment nothing but buying a piece of the business, which business has a promising future growth, and that translate to the valuation. That valuation, since we are talking about listed space, that valuation is the price of that particular company or stock. So the outcome is to create a fund or basket of a portfolio of stock where each one of us, like you, me, do invest. So that landscape is maybe rewritten or defined much deeper now with the advent of machine learning, with the advent of artificial intelligence. So I'll go step by step so that you can correlate what exactly where AI stepped in or machine learning stepped in. So in terms of any asset price, there are three components or driver to that particular price. These three components are valuation, which traditionally all the fund managers do follow, like fundamental research or the intrinsic value of any asset. But the other two part has been recently been researched, and that's where the implementation of machine learning and AI has come up. Other two parts are sentiment and liquidity. So sentiment on the valuation side is a traditional approach, what the traditional fund manager have been using. But the other two component, which is sentiment, like momentum, earning momentum, volatility, or public and social media sentiment. Another is flow data, be it a flow data related to a particular economy, country, segment, asset class, or the company. So these are the data are today available. That's the reason we have been able to practice or run this machine learning and generate a better insight. So typically this statement is very valid today. Any stock price or the company earnings typically have a lag or lead effect relationship. So that means ki today any company's earning may or may not reflect the true value of the share in the stock price. That is the reason we all are there. That is the reason the asset management industry exists. And that's where we depend on the asset manager to find out that anomalies based on the traditional, it's been fundamental data only. Today we do alternate data also, as I mentioned, sentiment data or liquidity or flow data. So there are very strong hypotheses in the market which has been practiced by last almost 50 years, 1970 onward. So the hypothesis says market in any efficient market there is no price arbitrage. So are we efficient market? when you compare with US, we are still an inefficient market, but globally there is no completely efficient market, neither in US, neither in India, but we are moving toward efficient market. That's why probably you have been hearing from your advisor or some of the forum, it is the time Indian investor also should invest in passive. So theory says in any efficient market, no fund manager could generate alpha. But is efficient market exist? Answer is still no. We are moving toward the efficiency because information is available across, data is available. In this environment, still there is a scope to generate alpha. That's where, as an asset manager like us, they try to use alternate data or machine learning to generate alpha. So I'll deep down how this process has been practiced. Almost more or less, whoever practice quantitative investment and what is the outcome of those practice. I have taken a context in India, so you'll find much more relevant from Indian context. So this is typically capital asset pricing model plus alpha. Why I said capital asset pricing model plus alpha is any asset, whatever asset comes to your mind, it has divided in three components. One is the risk-free rate, which is the risk-free rate of that particular country. In India is a 10-year GSEC rate, plus the premium you get by investing in a risky asset. Like you invest in equity market, you should get a return higher than your risk-free rate. So that component is depending on how much is the beta. So like market beta is 1. If your particular instrument beta is 1.5, you should expect 1.5x return over and above market. Now, why alpha has been shown separately is that is the fight across the world. Are we able to generate alpha? There has been a debate in last year. There is a very strong debate that Indian fund managers are not able to generate alpha, and so as globally. That's where the need of the hour is how machine learning or much more precision can help fund manager or investment management fraternity to generate alpha. So let's go back to the basic common sense, like what we are trying to achieve. We are trying to replicate the way human being behaves. Like whenever we see a cloudy weather, we pretend that there would be a rain. That's a basic common sense, and that's how that is the foundation of artificial intelligence. We are trying to create a binomial neurons to a artificial neurons and try to process the data the way we observe any informations or we hear anything. That's how the output comes. Same machine also behave in the same fashion if we can process the data correctly. So as I said, we are trying to replicate the way human brain works in the form of a machine. But is human brain is better or machine? That's where it's not a debate, it's just a perspective. In terms of neuron, there are 86 billion neurons works in human brain. But in machine, that much of neurons still we have not been able to generate, but the efficiency we have been able to increase. That's why we may require lesser neurons, but with the efficiency we can generate better processing. In terms of learning, human brain has a limited capacity. The good part is that human brain consumes lesser energy. So we need to, whoever are there in the space of AI, they already started realizing the compute cost is very high, and with the high processing, high compute requirement, the cost of AI will increase because of the compute cost. In terms of the memory, that's very important because in investment management, we always depend on the intelligence of the fund manager who has spent 20, 30 years in the same space, and that wisdom helps him or the team to identify the right investment. with the help of AI or machine learning, we can solve that without having that long years of experience. By the use of machine, you can actually generate better intelligence, because the memory is normally, it does not require reorganize to generate that intelligence, it automatically retains. In terms of the scalability, as compared to a human being, like there are market fund managers who have spent 30 years, they are about to retire. The intelligence they have got by managing the fund for last 30 years, they cannot transmit that intelligence to the next generation or maybe the next team of the fund manager in true sense. But by use of artificial intelligence, by use of machine learning, that is possible. So these are basic difference why today we believe, as in one of the asset managers who follow quantitative investment as a true sense, because first difference is it is unbiased. As a human being, we intend to, or we have a tendency to become biased toward our judgment, our decision. So as an investment process, we can neutralize that biasness. That's the first tenets of why quantitative investments are becoming popular globally, and that is helping the global fund managers to generate some alpha. So I'll touch upon the highlight of the construct of what we do in our investment management process. There are three parts to it when we talk about to achieve the AI-driven decision making. First part two is the machine learning. Second is deep learning. Third is reinforcement learning. Let me go quickly. So what do we do actually? So out of three processes, we adopt typically two. I'll talk about which two. So we largely adopt today machine learning because the data for Indian market, be it a macro data, market data, or alternate data are available. There are two types of data. One is standard and non-standard data. So in a machine learning process, we take the standardized data, which is the market data, and train the model to identify the factors which impact the price of that particular asset. Just to simplify that, if a company generates a good return consistently, it should reflect in the share price. That's one of the fundamental factors. So likewise, there are multiple factors. One of the factors could be analyst revision. As an analyst which predict the forward-looking earnings, if they revise any forward-looking price before the result, and it gives a positive surprise or a negative surprise by a degree, that also determines the direction of that particular stock price. So what we do in a practice is we identify the factors. So let's, for our discussion's sake, there are maybe 45 factors. Then we see the impact of each and every factors on the investment asset price, and identify those factors which has at least 85 to 95 degree of determinant, and create a basket, create a model, and run that model to identify the asset classes. So that's the first part of machine learning. Second part is deep learning, is largely not been used in listed space. This could be used in unlisted space because data for unlisted companies are very scarce. So mostly the fund manager in private equity space, they look at this kind of alternate data, but for a listed space, normally we don't use deep learning. Third is supervised and reinforcement learning. This is very critical, and that's where the efficiency would come. So today what we do, we always take historical data, run the machine learning to find out the factors which impact the asset price or the share price, give a respective weightage, and that optimize that portfolio. With time, what will happen? Today, still both the approach, traditional fund management approach also look back the historical data. This first phase of machine learning also look back the historical data. But with time, once we create a model and that model itself started reinforcement learning, where we give a higher weightage whenever the outcome and predictability, so outcome of the predictability comes correct, we give a higher weightage. And if that outcome is wrong, then we give a negative weightage. That's how the machine keep learning by its own model and gives a additional factor. So end objective is to reduce this loss function. Loss function is a predictive value of particular asset and the actual value in reality. If a model can reflect or articulate the right pricing, and if we can reduce the loss or the deviation, that's where the model is successful. The answer is there any model created by anyone in the world? Answer is no. One of the study, there is Jim Simons' portfolio, Medallion Fund, which has generated highest return for last 34 years. But unfortunately, they don't disclose the portfolio strategy or the structure, the AI they use in their portfolio model. So still, as we speak today, this is in iterative process or transition process. All the quantitative fund managers globally, the end goal is to reduce or minimize this loss function. But still, with a 80 to 85% accuracy or 80 to 85% of degree of determinant, fund will outperform the traditional fund manager. That's the objective today. So there are different processes like linear regression or logistic regression. That's just a framework. So let's come to the outcome. By doing that, what we have done, we have taken a data for India. So we have backtested for historical data and tried to compare with all the funds. One, we have taken all the index, the broader index, which is Nifty 500. Then we have taken a single factor also. There is an index in the Nifty, that's a single factor, which is momentum, because India is a structural bull market where the momentum works. So we have taken a momentum as one of the factor. Then we have taken a multi-factor also, defined multi-factors. As we evolve, there are factors identified by the index constituent companies. So we have taken that also. On top of that, when we tested by using machine learning or artificial, I'll call it more of a machine learning than artificial intelligence, we have observed the portfolio, which is in yellow. It has actually outperformed all the indices over last 5 years. So just to give a perspective, Nifty 500 has generated a return of 20% CAGR. It has generated alpha of 13%. It has given a CAGR of 33% in last 5 years. These are just again, as a disclaimer, this we do for a day in, day out basis. This outcome or backtesting result is just a reflection of that, what we practice on a daily basis. I don't recommend or solicit any investment to the fund. This is just for illustration and to clarify what we practice and how the outcome is. So with that, maybe I'll take a pause, and thank you so much for your time. I'll take a pause. Yes, so I have kept 2 minutes for if you have any question. Yes, madam.
Very short question.
Sir, madam, after I'll come. Yes.
Sorry. I just wanted, it's not a question directly related to investment, but sentiment, how do you pick up? Because on the service space, sentiment is what word you use? Happy, sad?
Very good, very good. So sentiment, what we do, we take professional news and social media news. We get a machine readable news, And as you correctly said, there are words we do the ranking or scoring from -1 to +1, and that's how the we parameterize. Yes, sir. Yes.
My question is related to the turbulence, what happens in the market because of some event.
Yes, sir.
It can be some announcement, somebody falling sick or too much rain. And maximum variation of loss or profit happens during that time. I
Yes.
think no AI can predict such.
Yes, you are absolutely correct. Let me go to the earlier slide. That's what I have shown. Volatility. If you look at the volatility, would be there. The idea is, can you ignore that drip or drawdown? Answer is no. But you can take a corrective action so that whenever there is a recovery, you recover faster. That's it. Thank you.
Alok Sasmal, your this model,
Yes.
is it required regulatory approval?
So regulators say, since we are also SEBI regulated,
Yes.
they say the broader model, what are the parameter we are using. So we have already disclosed that to the regulator, and the broader framework. So quantitative funds is SEBI. It's already under the purview of SEBI. There are a couple of mutual fund also they practice. But what we have improved on this, maybe that is a single factor or couple of factors. We are doing a multi-factor dynamic. So dynamism with every input we are taking, we are running machine learning. So more of an iterative process. That's an extension of the traditional quant fund.
Because regulator is little worried about even Reserve Bank of India on the certain bias, certain assumptions or certain whatever from
Yes.
the past records, data, all that. Such model needs to be vetted.
Yes.
And once it's vetted and it's proved reasonable level of efficiency ratio,
Yes, yes.
then that could be, because quite a lot of people will be depend on your model or somebody or your own customers, then they must not later lead into any extreme.
Yes, you are correct. Just a small caveat. So, what regulator, be it a SEBI or RBI, looks at, they look at high frequency trading or algo trading, which disrupt the market architecture. Since we are a low latency or high frequency, our optimization happens once in a month. So, it is typically long only. So, long only fund never disturb the market architecture. What happened in recent one of the algo trading.
Thank you.
Yeah, thank you. Yes.
I'm so sorry, the time's up.
We'll connect. Yeah, thank you.
Thank you so much, Alok. I'm sure a lot of our investors in the room would have learned a lot. And of course, AI brought into this realm is really fascinating to see how it's evolving. On that note, of course, I'd like to invite Dr. Narendra to please join us on stage. We'd also like to take an opportunity of inviting Mohan G, who's a strategic advisor with SWIFT and ex-chairman of Central Bank of India. He's also the ex-CEO of Indian Bank Association. Truly an honor, Mr. Mohan, having you on stage. We'd also request the Global Head Strategy and Algorithm Trading of Bullforce, Mr. Vignesh Reddy, to please join us. Mr. Reddy, we'd request your presence as well. Let's give him a big, big round of applause as we welcome Mr. Reddy. And such an honor having Mr. Mohan join us. We'd also request a microphone to be passed to our dignitary on the stage.
See, in the banking industry, there will not be anybody who will not know Mr. Tangsale, Mohan Tangsale. And a great achiever, as well as Union Bank, and he went to Punjab National Bank as Executive Director, then came to Central Bank as MD or Chairman, CMD, and then became the CEO of IBA. And during his period in IBA, it is extraordinary activities. And he has been passionate about technology also. So our SWIFT has taken him as a strategic advisor. So such a great man, on my request, he has come here. And one more thing I want to hear from him only, he has released a book recently. Quite a lot of us know we achieve in the banking industry quite a lot of things. But we don't maintain anywhere to write a book. But he wrote a book and it is now widely circulated, sir. Please tell. So that we have to honor.
Thank you, Narendra.
thanks Encube Collaboration for this opportunity. As a banker, I spent about 45 years in the banking industry. As you said, Union Bank, Financial Bank, Central Bank, then IBA, which is a representative body for the banking industry. So you get a lot of learnings and experiences. Now, as a responsible banker, you also have to give back. And what used to happen that whenever I used to go for addressing various colleges, management institutes, bankers, sir, aap kuch likhiye na. And thus I said, I don't know to write the biography, but yes, I would like to share my learnings and experiences. And that's what I have captured in my book called Banking Beyond Borders. If you want, I can show the copy. It is
Yes,
with
sir.
me.
Yes. Your bag.
वो bag ला देना थोड़ा सा.
It is a better.
So,
because everybody who wants to go into banking, particularly we have students sir, here.
Oh, great.
So they will be happy.
You can open and there is a book inside. So the book is what has been my learnings and experience through my journey in the banking industry, right from my joining as a clerk to start with, becoming probationary officer in a short while, then branch manager of rural, semi-urban, urban, metro, right up to the chairman. And that was the time when the banking industry has seen the complete evolution. Many of you who are young may not be aware what has been the crisis in 1991, which led to the complete reformation called LPG, liberalization, privatization, and globalization. And the entire technology in the banking industry started from 1988, Rangarajan Committee. And today I am so glad to say that the banking industry is an accomplished institution as regards the usage of the technology is concerned. The treasuries of the banks are very big. I am very sure they must be, we have been in our time using only Bloomberg and all those things. Now that many players are, and as rightly said in your presentation, I think the behavioral finance is extremely important. And that behavioral finance gets decided based on the data. And if the data is properly collected and interpreted. So here the importance is that of the data integrity. That's most important. If the data integrity is maintained and if it is properly interpreted, I think you do get the good results through the AI. And my best wishes to you. Thank you so much. Thank you, Narendra.
So we are fortunate and with this, because one more thing, like some of them are sharing. सर आपका रिटायर होने के बाद भी आपका ये एनर्जी है तो मेरे से ज़्यादा एनर्जी इनका पास है सो दैट इज़ वेरी इंपॉर्टेंट सो ही विल बी वन ऑफ द रोल मॉडल फॉर बैंकर्स सो आई सर हमारा एक स्मॉल
लेट मी प्रेजेंट दिस बुक टू हिम
यस या दैट इज गुड
Well, truly, what a heartening moment it is when you have bankers with more than, I would say, 100 years on stage.
Thank you.
So collectively, both of them in the center represent more than 80 years. So you can understand the experiential sharing being implemented. So with that, thank you to all our pioneers of this industry for joining us. And of course, the conversation continues at the AI Conclave. Thank you so much, Dr. Narendra. Thank you, Mr. Mohan. Such a pleasure having you. And thank you so much to our speaker.